in working on this and setting it up, we tried to make it very user-friendly, tried to make it very logical, you know, and Lauren will get into some of this a little bit when she's talking about the tool. We'll run through a couple of examples with it. But one of the nice things that I like about this is the whole idea is that you can look at multiple what-ifs, you know, and change all sorts of input assumptions, cost assumptions, establishment assumptions, things like that, and see what some of these different outcomes become. What happens if you completely eliminate a tillage pass? What happens if you have livestock that's able to utilize and things of that nature? So all these partial budgeting analysis things allow us to be able to look at that. We don't have to worry about putting together an entire crop budget and a production model and everything else. All we're looking at is what changes in that individual operation. You know, and in that partial budgeting framework, that's my favorite animal of all. I just wish I could keep a cash cow around, but that's my sense of humor are like my gray hair; they just fall flat. So
maybe it'd work better if you took that tie off.
Yeah. Hi, Bryon.
All right, how about if I just loosen it up? Okay.
That's good.
Okay. The other thing that I wanted to bring up and discuss briefly too, as we looked at this tool, we tried to focus on the costs and benefits that are going to accrue to that producer or that landowner. There's a lot of different externalities that are discussed that they come in under the names of things like environmental services and different issues with water quality and credit trading and things of that nature. We deal very, very little with that in this tool because part of it is they're difficult to quantify, they're difficult to measure, and they're difficult to monetize. Again, that we're trying to look at, you know, because it's the producers and those landowners, they're the ones making the decisions, so we wanted to try and put together a tool that would reflect those costs and returns to them so that they're able to evaluate on their operation. One thing that makes it a huge difference, and we've tried to address in this tool, is this whole discussion of short-term versus long-term. If you talk to any number of producers, that they will tell you that there's some ground that they have, most likely, that's rented on a short-term basis. And you know, in Illinois, 82% of our farm ground is rented. Typical term is annual. You know, that's not to say none of those leases ever get, you know, renewed. In fact, a lot of them are built on, you know, established relationships. But if there's high-risk ground, you know, what you're going to be looking for in returns on something that you're only going to keep for a year or two is something different than what you're going to be able to keep for multiple years, you know, 10, 20 years or something of that nature. Also, we're looking at from the perspective of that when you look at those changes, and we know changes occur over time, the short-term versus long-term benefits part of the model does do that. The model will look at an evaluation for up to 50 years. You know, that sounds like a long time, but if you think of a producer that begins in their career maybe between 20 and 22 years old, what's 50 years? 70, 72. Maybe that's about the time they're starting to look to retire. So if you're trying to look at a long-term evaluation, especially on owned ground, the ability to project that far out becomes relatively important. And then that just, you know, what happens, and you'll see when we run the model itself how some of these calculations change at certain benchmark periods as soil organic matter is built up, different nutrient changes occur in the soil and things of that nature. You'll be able to see how those benefits can accrue and build upon themselves. So, with that being said, that's just contact information. Like I said, Lauren and I's contact information is on there for that as well, but that's also then as a nice slide that Lauren really likes because she likes that particular shot.
Crimson clover.
So
it's my favorite cover crop. All right, thank you, Bryon. So with that introduction, we're going to jump right into the tool. Where is it?
Should be right underneath the slide set.
One of the things I want to point out, just really quickly, when you open them all, we do have a couple of tabs. We have an instructions tab, which we always recommend. I'm the worst about reading instructions, but we did work hard to put it together. So it should help with using the tool. Also, and Bryon gets kudos for this. He really dealt into the literature. We really tried to build the tool and put the default variables in based on what's in the literature. There's not a lot, but what's in the literature, and so we do have a literature review there for people to do some of their own research, and we'll continue to add to that as we expand on the tool. But basically, when you go to the short term, the first thing you're going to do for your operation is select how many years of crop rotation you currently use. So if you do a corn soybean, it's 2 year, and et cetera, et cetera. And then you'll start the model. Now, just for ease of simplicity, we also have a bunch of default variables built into the model. We have up to 5. These can be changed as you get used to the model. You can actually build new defaults. But just in the interest of time, I'm going to go ahead and start with our soybeans, corn default that I already have built into the model. When you open it up, what you get basically is side by side, because we're talking about a 2-year rotation, so you get 2 columns side by side. And the first year, that's when our soybeans are coming in, and the second year is modeling the corn crop. Now, the way the cover crop works in this model is you're modeling the cover crop that you planted prior to that cash crop. So the soybean column 1, we're going to be looking at whatever we planted after the last corn harvest came out. You planted a fall cover crop, and then you're coming in with soybeans afterwards. And then the second cash crop, corn, you're looking at the benefits to that cash crop from the cover crop you planted prior to your corn. Okay, so after you harvested your soybeans, put a fall crop in. And that's the way this default's working. So, just like any economic model, you're looking at costs and benefits. So first, let's start with the costs. And the short-term costs that we've identified, first of all, is your cover crop establishment management. And right now, we're assuming that before your soybean, you're going to plant cereal rye. It's a very common cover crop before soybeans, especially for people starting out. And you want to put in, of course, your seeding rate and your seed costs, your planting costs, any termination costs. Now, if it's winter kill, you wouldn't have termination costs, but with cereal rye, you would.
Seeding rate's a little high.
Yeah,
the seeding rate's a little high?
It's just a model, but yeah, I meant that's
So what would you normally put cereal rye in at? 50. Okay, so you can see you can just change it very simply. And then any increased management costs. Now this may or may not be available for you, but especially for a new producer, if you're going to spend more time in the field, there's a value to that, there's a cost to that, so that's what that'll capture. And then you can see we did the same for the corn, and we modeled doing a mix of like cereal rye, clover, and brassica, for example, in this example. Okay, the next cost is a possible yield decrease. Now, this is one of those things that may or may not happen. Ideally, with cover crops, we're benefiting the next crop and having a yield increase, but there is a possibility. There are certain situations where the cover crop could cause a yield decrease. So we do have the ability for you to model that. Now, what that's based on is a percent of your, a percent. So like up here, you put that your typical soybean is 50 bushel per acre and $10 a bushel. Of course, you can change all that. So if you were to model a percent decrease, say 1%, you put the 1% in and that will calculate that for you. Now, in our default, we're saying it's 0% because we're saying that you're not going to have a failure like that, or you're not going to have a negative impact to your cover crop, but that could happen. Now, the third cost category we built into the models is other. So this is this is a cover your butt kind of variable. There's always, cover crops are kind of new. Every situation is different. Every producer is different. You may have other costs. Maybe you have to do something extra out in the field because of the cover crop that you wouldn't have had to do. And so this is a way to capture it. We have a text box here. You can just type in what that cost is and put the cost per acre.
What if you have a yield increase?
We're getting there because that's a benefit.
Those are benefits.
Absolutely. I love it when people pave the way for me. All right, so what this does in the model, it calculates for you the total cost per acre of those costs that you just entered. So right now we're saying that it's $43 an acre to do our cereal rye before our soybeans, and it costs us $59 an acre to do our mix before our corn. Okay? All right, so the next part of the model is the benefits. Okay, we need to look at what the benefits are. And one of the first benefits that we came up with in literature is the potential for direct nutrient credit. So that because of the cover crop, you actually can reduce some inputs you're putting nutrient-wise into that cash crop. Now, this isn't always the case in the short term, and when we get to the long-term part of the model, we'll address this for the long-term aspects of that. But what we've done, for example, here before corn, where we have a legume in, is we've captured 30 pounds of N from that cover crop, and we're saying that that's 30 pounds you don't have to put on that corn crop. Now, this may or may not be the case. This is individual for your operation, but there's a potential that, and you can capture that here. All right. The next benefit that we capture in the model is the potential to be able to reduce some input costs such as herbicides, insecticides, or fungicides. So one of the things we found in some of the research trials going on in Missouri at the research farm there and with producers, and we've seen in the literature, is especially a reduction of herbicide costs because of the weed management. With the thatch that the cover crop leaves, if you can plant into that you do get quite a bit of weed management, and that seems to be a very common. A lot of producers are saying they're able to reduce their herbicide costs pretty quickly. So this is a way to capture that, and the way you capture the models, you estimate your dollars per acre that you usually spend on herbicide, for example, and then what the reduction was. And when we model right now, we said that this producer would spend $20 an acre for herbicide management for their soybeans, and that they can reduce that by 15%. And then here's the corn. Okay, and then you can do the same for insecticide, fungicide.
Can I throw in a comment?
Sure.
If you go back up to your initial cover crop costs, you got $10 for termination in there.
Mm-hmm.
To me, it looks like you're adding that in twice because that's going to be the burn down.
Right, so that's a very good point.
Assuming that you do a burn down program.
Okay.
Yeah, so this $10 is to actually terminate the cover crop. And then the reduction of herbicide is the additional herbicides you would have used during your soybean management. Okay? So it's different. You have to keep that different. Now, because if not, I mean, essentially, you may end up spending more on herbicide because of the burn down where you wouldn't have done it before. But maybe you would have done a spring burn down anyway. So maybe now you can consider that termination cost your spring burn down, and then maybe later in the season you don't have to do that herbicide pass that you had to do without cover crop.
I was just asking.
It's a good question because it's important to keep that straight.
It's a little different.
A little different, and you can model it. I mean, you don't have to model it this way. You can model it, if you think about it differently. You can model it however you need. But yeah, that's a good question. That's a good point. All right, now here is your yield increase. And this is obviously what we'd like to see. And so again, if you think that you're going to get a yield increase right now, in our model, in our default scenario, we're given a 2% yield increase to our soybean after sow rye, and that seems to be something we're seeing in the field. The corn seems to be a little trickier in the short run. So we're just saying that there's no change in yield, no cost, but no benefit. And the next benefit we're capturing the model is erosion reduction. Again, this is one of those benefits you can get pretty quickly, immediately, once you start using cover crops, depending on what the previous management was. So here is where we've kind of gone out of our rule of only looking at on-site benefits, because we did add this off-site water quality variable in here. Of course, you can just zero that out if you really don't value that necessarily. You really just want to look on-farm. The on-farm value of erosion is the lost fertility value, basically. It's the nutrients that are now not leaving your farm because you have less soil leaving your farm. Okay? And then the offsite value is its water quality benefits, basically. So.
And that's not just a made-up number. I mean, those two particular numbers come out of some vetted research work that was actually provided to Congress as part of the equip cost-benefit analysis. But it also serves as a placeholder a little bit too, that as we get the opportunity to look at some of these things as time progresses, and if we're able to start getting some values for some of those externalities, that's a way to be able to address it.
Okay, so I have 5 minutes. I gotta rush real quick and then some questions. So I think we have time for questions, right? Is that built into this 5 more minutes? So I need to get through the model. Okay, so in this model, I'm saying that you're reducing erosion by 4 tons per acre. Again, it depends on your land, depends on how you're managing it previously. And then this calculates for you the erosion benefit. I do have this erosion repair value. This came out of some producers in Missouri that say that because using cover crops, they don't actually have to go out with machinery and clean out ditches anymore. So that's what that captures, if that's something from your operation. Other benefits, again, it's a catch-all that we capture. All right, so you get down the bottom, it calculates your total benefits we just put in, $41 an acre and $47 an acre for the corn. Okay, and then you get the results. And here it shows you the net benefits, basically, for each year, the short term, and it's a $2.38 cost for the soybean and $11.42 cost for the corn. Now, let me make a point about that. we're doing a partial budget analysis. We're looking at what changes. So what does a negative 238 mean in this analysis? Does it mean that you're losing money on your operation? The answer is no, because what that means is instead of that cover crop costing you $40 an acre, the cover crop only costs you $2.38 an acre, because you got to factor in the benefits you're getting from the cover crop. Okay, that's how the partial budget works. Now, this doesn't mean, again, this is a model, and it's a very conservative model that we've put together. You can change the variables. We do have producers that are finding short-term that they are able to get enough benefits to cover the cost of that cover crop, but we like to present a fairly conservative model. So let's move over to the long-term analysis. So that's the year-to-year. Now let's say we're going to do the analysis for 25 years. Let's say that you're a landowner and you're looking to the future and you want to see what's going to happen. If I was going to do this management with cover crops for a long period of time, I want to see how many more benefits would accrue as my soil improves. So this prime model captures that. We're assuming a 25-year. Again, Bryon said we can do it for 50-year. You need to give it a discount rate. That's just an economist thing because time has a value. Money has a value of time. Time value money. Right? You need to tell the model what your current soil organic matter is. It needs to know where you're starting. It needs to know where your potential soil organic matter is of your soil. Soil has a maximum potential, okay, based on inherent soil properties. And then it needs to know how many years does it take to increase that soil organic matter 1% by using cover crops, okay? We're using 10 years. That's what we've got in the literature. You may be able to do that faster. But that's an estimate that we've talked to some researchers about. This is bringing over your cost from the short-term analysis for your establishment management. This is bringing over the short-term benefits we've already modeled, okay? So now let's talk about the long-term benefits. We've got 2 long-term benefits the model will add on, okay? First is the overall soil fertility benefit. As your soil organic matter increases, nutrient cycle, biological activity increases. There's a lot of science there that we're not scientists, we're economists, but we've tried to learn. And therefore you have more nutrient cycling. And so what the literature has shown us is that for each 1% of soil organic matter, that you're going to get some NPK, sulfur, probably some carbon. Now, does carbon have a value? Not really right now, but maybe we'll have a carbon market at some point. Maybe it will have a value. So we have a variable in there right now. I have it zeroed out, but you can certainly put a value in there. Right now, we're saying that for each 1% soil organic matter, you're going to get 20 pounds of nitrogen. Your soil is going to provide for you 20 pounds of nitrogen, 2 pounds of phosphorus, and a little bit of sulfur. Okay, again, we're just pulling that from what we can find in the literature right now. All right, and then it calculates what that benefit is to you. So after 10 years, you're going to start accruing some of these nutrient benefits. The other long-term benefit is water storage. As your soil organic matter increases and your soil porosity increases and all the properties of the soil improve, you're going to hold more water that falls on that soil. And that's a benefit too. Now, that's either a benefit in reduced irrigation if you're an irrigation farmer, or if you're a dryland farmer, that's a benefit in the fact that maybe during drought years, you're going to have less of a yield reduction. Okay, so there's several ways to calculate that. And there's your benefit. Now, for the results, we take all this and shake it up and do what economists do, and we get our net benefits over 25 years is $14.20 an acre a year. What that means for an economist and for you is that this change in your operation based on this default model we provide and these variables is profitable over 25 years. But what's probably more important to you as a producer is your year-to-year financial analysis results, and this is portrayed here. And you can see here, this was the original $2 cost and $11 cost from our short-term model. But then after 10 years, you're going to start getting those long-term benefits. Okay, those long-term benefits are going to kick in because you're getting that extra soil organic matter from using cover crops. And that's what the model's showing. Let me show that graphically because it's a little easier to see. Okay, so this shows you these long-term soil fertility water storage benefits, how the model handles them. After 10 years, because we told them I was going to take 10 years to increase soil organic matter 1%, all of a sudden you start getting benefits on your soil fertility and water storage, and then after 20 years it bumps up again. It's a step function. Now, in reality, it's probably more of a curve function, but it's not really a big deal from the economic standpoint to model it this way. It's a lot easier to understand. And I don't know what the curve would be. I've never seen anything in literature that gives me a curve function that I can use. So we just use a step function. It's a little more conservative analysis, but it gets the point across. And then here's your financial analysis net benefits. So this shows in the first 10 years, you've got just a minor net cost. And if you invest in that after that, you're going to have benefits occurring over time. Do I have like 1 minute to show the grazing?
Of course.
Okay. I just want to show you one more thing about the model. Do any of you graze? Any of y'all livestock in the room? Okay, then I'm going to try to convince you to. All right. Let's say that you could have the ability to integrate livestock in your operation.
Without all the infrastructure costs.
It's just a thing.
The fence automatically gets there, right?
The fence is automatically there.
Yeah,
This
compared
works
to farm
this
that's
works
already
really
got a
well when
good
people actually
perimeter
raise their
fence.
hand and says, yes, I have livestock, which happens more in Missouri. But I just want to show you, just to kind of show you how the model can handle this. But let's say that you have a cow-calf operation, and
Do you mind using the stockers?
I don't mind if you help me with some information. So I don't have it off the top. I haven't looked up the data and stuff.
Okay, you go back to where you.
Okay. Do you know off the top of your head some of the value of
Yeah,
stockers?
yeah,
Okay.
I can do stock.
Okay, let's assume that you already have the infrastructure, so you're somebody who already grazes, and I can work with you individually on how to actually model it if you're starting it out, but just assuming, and that you can take and graze those stockers for at least say 30 days, either in the fall if you can get the cover crops established after the corn or the soybeans comes off, and you can get it established enough to maybe graze it for 30 days, or in the spring. After it gets a spring flush, you can get out there and get the stockers out there for like 30 days.
But yeah, just to be able to run this, because I know we're getting punched on time.
Yeah.
The additional, I'd probably be more like 0.7. Don't because this is the additional gain that they would get as opposed to being fed hay or the pasture or whatever they're on. This is what they would get in addition by being on this improved
what's the value
forage.
of a pound right now?
Call it, be conservative, $1.50. We know feeder calves are selling for more than that right now.
Okay, let's
But
say
even at $1.50,
so you
30
can get 30 days either in the fall or the spring.
and on a short-term one like that, I know conservatively you can do 4 head to the acre.
Let's do 4 head to the acre.
126.
And let's say you can just do this one year out of your 2-year crop rotation. Look what that does to your net benefits. So let's see what that does to your net profitability. $80. So what was it before? About 9 or 11. And then here's your graph. Looks like Charlie Brown's. We just did 1 year of the 2. If you did 2, it wouldn't look. But you can see what that does even in the short term. This is when I've got producers. I'm working with producers that already have livestock, but they've got them like separate in their operation right now. This is what we're talking about because this is a huge way to integrate that operation and make some and really pay for this cover crops and actually enhance their operation. So I just wanted to show that, even though none of you raised your hands with your livestock. So sad.
Do you have any factor in there for a yield loss to the subsequent crop from plugging, stand reduction, anything?
Okay, you can plug that in if you think that'll happen. The idea is that you're going to manage it correctly though with the livestock.
Can't manage 40 inches of rain and know when it's going to
Right, and if you think that's going to happen, you could certainly go back to the short-term model and say, okay, I'm going to incorporate livestock, but then I'm going to be really conservative and say, like, because of livestock, I might have a situation where it's hard to manage because of the rain, that, I might end up having a little bit of a yield decrease. And so you could plug that in and then still run the model. And in this case, if you just assume a moderate yield decrease, you're still coming out ahead. Now, if you think you're going to really have a loss and they're going to really mess it up, that you can play with the model and figure that out. But you certainly, especially with stocker prices, beef prices right now,
But
you've got some room.
should model an increase and a decrease in the same year.
Yeah, you don't want to model increase and decrease the same year. And
The other thing you need to build into there is as your stocker increases in weight, he goes down in price.
Well, that's why I say, it's.
You got to model that in as well. Not all of your gain is directed at that same price that you're looking at.
Right, so
Everybody
you can reduce your gain value if you think that's going to be something that you're going to experience. Absolutely, you can reduce your gain value.
Great.
Okay, so I had to really rush through the end there, but
After looking at that, I think everybody's going to be.
Where is this available? I gotta go.
here, give them the flyer. Okay, so that gives you guys an overview of the model. Again, there's a lot, we can play a lot more, but that's sort of the overview of how it works.
Yeah,
so.
and we'll be here later today if anybody's got personalized questions that they want to ask, run through the
And
model.
actually, I think during the evening, during the evening, just mix and match session, we're gonna have a couple computers set up. So if anybody wants me to sit down with them, or Bryon to actually run them off your operation, plug some numbers in with me. I'd love to do that because I'm really trying to capture some anecdotal scenarios to start building some more defaults. Okay, any
Person
questions?
was interested. I understand there's probably a few quick dollars that can help put fences up.
We do have, yeah, I mean, we do have an equip program. So,
And
yeah.
but to that point too, we built this model to be completely independent of any program decision somebody would make. You know, it's like the other question that's been brought up. It's tillage neutral. It doesn't assume any type of a given tillage program. You could be moldboard plowing or you could be a 20-year no-tiller. The model will still function the same.
Of course, if you're tilling, you need to, you may not be building your organic matter as quickly.
Right, but there will be some differences on the back end, but again, part of that's addressed in that literature review.
Any questions? Yeah.
For the erosion benefits based on SFL, or what was the model you guys used?
Part of that is because that's going to be site specific. The values themselves, as we said earlier, come from the equip benefit cost analysis that was provided to Congress. That particular number that we got plugged in the model is just a number we use for this model. On farm A, it might actually be 0. On the farm 3 miles down the road, it might be 8. That's going to be something you're going to plug in for a specific farm, even down to specific fields.
So what you want to think about with that value is, first of all, how much erosion is coming off your field that your cover crops might curtail. And then how much value of fertility do you think is leaving that field? So if you think that so many pounds of nitrogen are leaving, what's the value of nitrogen? That's kind of how you back into the dollar value per ton.
I was just wondering what the name of the model was.
I don't know the name of the model they use to do the equip benefit cost analysis. I have to dig into that. So
Yeah, it's listed in the literature as just a quick benefit cost analysis. It was 2009 or 2010.
Any other questions?
Well, if you do have any other questions, they will be available.
Okay, thank you very much.
Afterwards. Thank you very much.